Marginal versus effective tax rates. Here's what you need to know. So often when people talk about taxes in general, they're really just focused on a single number and it's their tax bracket. So I'm in the 12% bracket, the 22% bracket, 24%, 32, 35% bracket, right? A lot of thoughts are, I will definitely be in a lower bracket in retirement, or Roth just doesn't make sense for me because my income is too high right now. And in my experience in working with clients, this line of thinking is where a lot of well-intentioned tax planning can go off the rails. And here's why. Because your marginal and your effective tax rate are not the same at all. And confusing the two can lead to a lot of decisions that are unclear, especially when choosing between Roth and pre-tax contributions. Let me break this down for you so it's clear. So first, let's just go over the differences between marginal and effective tax rate. So number one, marginal tax rate. So this is the tax bracket that your last dollar of income falls into. So if you're in the 24% bracket, that does not mean all of your income is taxed at 24%. It just means the top slice of your income is taxed at that rate. Okay, so our US tax system, it's a progressive tax system. So income is layered across tax brackets, not dumped into one. So it means some of your income might have been taxed at 10%, some at 12%, some at 22%, and then some at 24%. So marginal tax rate tells us what our last dollar of income falls into, but it definitely does not tell us the whole story. Second, your effective tax rate. Think of this as what you actually pay on average in taxes. So your effective tax rate looks at your total federal income tax paid divided by your total income. So this reflects your lower tax brackets that you filled first, impact of deductions and credits, standard deduction, whatever that was. And it's considering that the fact that only a portion of your income is taxed at the highest tax bracket that you fall into, your marginal rate. So you can have a 24% marginal tax rate and still have an effective tax rate of 10 or 12% or 14%. So typically your effective tax rate is going to be significantly lower than your marginal tax rate. One of the most common pieces of generic advice that you typically hear is if you're in a high tax bracket today, you should always make pre-tax contributions. That focus really only focuses on marginal rates, right? And if it ignores effective rates entirely, because I see many high income earners that actually have a really, really low effective tax rate. So if your marginal tax rate is high, but your effective tax rate is relatively low, defaulting to pre-tax contributions may not be as advantageous as it seems. Why is this? Well, because Roth decisions aren't about what your top dollar is taxed at. They're about what your rate you're actually paying today versus what you might pay in the future. So consider two different taxpayers, both in the 24% marginal tax bracket, right? Person A barely crosses into the 24% tax bracket versus person B, their income fills up most of the 24% tax bracket. So even though they have the same marginal tax rate, their effective tax rates can be very, very different. So from a planning standpoint, someone at the bottom of a bracket often has far more flexibility versus someone completely filling the bracket has less room before taxes meaningfully rise. This is why Roth versus pre-tax should not just be based off your marginal tax bracket. A lot of times when we think of high income, people think it means high lifetime taxes, high effective tax rates, pre-tax contributions always. But in reality, we need to take a look and actually a deep dive into what's the effective tax rate today? What's the expected future taxable income sources? Are we going to have high required minimum distributions? What's our filing status? What's our timing of income? There's a whole lot more to look at versus just our marginal tax bracket today, which is the go-to for most people. Here's a more meaningful way to think about this. Rather than asking what marginal tax bracket am I in today, a better question is what rate am I actually paying on the dollars today that I'm either choosing to defer taxes on or pay the taxes on. Bottom line is there's no one size fits all when it comes to Roth versus pre-tax, but understanding marginal versus effective tax rate is foundational in making good tax planning decisions.